Welcome back to the deep dive. Today we're plunging into a really tough situation surrounding Fiserv, ticker FI. It's this huge financial tech company.
Huge is right. And they've just gone through what, well, analysts are calling a major crisis of confidence, even a failure of governance.
Yeah, it's pretty serious. We saw that shocking headline back on October 29th, 2025. The stock just collapsed.
44%
Yeah.
in a single day. And that was on top of an already rough year, down about 68% year-to-date overall. It's staggering.
It really is. So our mission today, using the public sources we've gathered, is to really dig into this core conflict. Is Fiserv now what you'd call a value trap?
You know, a business that looks cheap but is actually fundamentally broken.
Exactly. Or is this a massive, deep value opportunity, a solid company, maybe a bit bruised, that the market just completely overreacted to?
That's the multi-billion-dollar question, isn't it? We're going to trace this whole thing from management's own admissions right down to the, frankly, wild valuation metrics.
Okay, before we dive in, just the usual reminder. This is all based on public info. It's for educational discussion, definitely not investment advice. Always do your own research.
Absolutely. And speaking of tracking things, if you want to keep an eye on the overall market temperature, you might find the iOS app Buffett Indicator useful. It's on the Apple App Store.
Good tip. Okay, let's
Right.
get into it. Section 1, the confession itself.
Right, the Q3 2025 earnings report. That's where it all came crashing down.
The numbers were just, wow. Revenue was $5.26 billion, flat year over year.
Yeah, and the market expected $5.69 billion. That's a miss of over 7%. Pretty big for a company this size.
And adjusted earnings per share, way off. $2.04 versus estimates of $2.65.
That's almost a 23% miss on earnings. Huge. But honestly, the number that really told the story, the smoking gun, was organic revenue growth.
Ah, okay. What was that?
Well, analysts were looking for like 8.9% growth, healthy expanding business.
And Fiserv delivered.
1%, barely positive, just one.
Wow. So an almost 800 basis point miss on organic growth. That's not just a slowdown.
Exactly. It signaled something deeper was wrong. The core business wasn't firing.
Yeah.
And management's reaction, they immediately slashed the full-year growth guidance from 10% way down to like 3.54%.
Which pretty much confirms the previous guidance was totally unrealistic.
That's precisely what the new CEO, Michael Lyons, admitted. He basically called the prior guidance, which, remember, they'd reaffirmed just 3 months earlier, a fantasy.
Fantasy. Strong words.
Yeah. He said the assumptions were objectively difficult to achieve, built on like wishful thinking about record sales activity that just wasn't happening.
So why? Why cling to this fantasy? What was the prior team thinking?
Well, the analysis points pretty clearly to one thing. They were starving the business to prop up short-term results.
How so?
The strategy was all about deferring investments, kicking the can down the road on R&D, tech upgrades, even staffing, and cutting costs wherever they could just to make the margins look better temporarily.
Ah, okay. So they were sacrificing the long term for the short term.
Precisely. And the direct result, these competitive gaps started opening up. Client service suffered. It damaged the core operations, the very engine of the company.
And you can bet the market saw that connection immediately.
Oh, yeah. Almost instantly, a securities class action lawsuit was filed. It covers that exact period between the rosy fantasy guidance in July and the October confession. Management's own words are now Exhibit A, basically.
Okay, so this strategy of neglecting the business, how badly did it hurt their competitive position, their moat? Let's maybe quickly define Fiserv's business first.
Good idea. It's massive, split into two main parts, roughly equal in size. First is financial solutions.
That's the old school core banking stuff, right? Serving thousands of banks and credit unions.
Exactly. It touches like nearly every U.S. household indirectly. The moat there is traditionally huge, massive switching costs. It takes years, tons of money, huge operational and regulatory risk for a bank to rip out its core system.
So very sticky customers.
Extremely sticky. That part is like a fortress. Then you have merchant solutions, which is mostly their Clover point-of-sale system.
That's the growth engine or perceived growth engine. Restaurants, retail shops.
Right. Over 700,000 businesses. More than 4 million Clover devices sold. It's a big SaaS ecosystem. But the moat here is different. It relies on keeping those merchants happy.
Okay, I see where this is going. If you start deferring investments and cutting corners on client service,
You directly increase the pain of staying for those Clover merchants. Unlike the big banks, they can switch more easily.
so the neglect didn't necessarily break the big bank fortress, but it basically opened the door for competitors on the merchant side.
Precisely. Competitors like Square, like Toast, they thrive when the incumbent gets complacent or lets service slip. Fiserv's old management basically handed them a powerful wedge, as one source put it, self-inflicted damage to that merchant moat.
And this operational mess was happening while management was making some questionable capital allocation decisions?
Questionable was putting it mildly. Catastrophic might be better. They bought back an incredible $5.4 billion worth of Fiserv stock through August 2025.
$5.4 billion.
Wow. And get this, $4.4 billion of that was just in the first half of 2025. Think about the timing. The stock hit its all-time high, around $237, in March 2025.
No. So they were buying back stock hand over fist near the absolute peak.
Wildly overpriced stock, yes. Using billions that absolutely should have gone into fixing the emerging problems, into R&D, into client support, the very things they were starving. It's just a textbook example of bad capital allocation.
And the governance, the board, the big shareholders, where were they?
Well, that's another layer to this. There was actually a shareholder proposal back in May 2025, just 5 months before the crash. It proposed clawing back executive pay specifically for negligence.
Okay. Seems relevant now.
You'd think.
Yeah.
But the big institutional holders, BlackRock, State Street, the usual suspect, they voted overwhelmingly against it.
Seriously. They voted against clawing back pay for negligence right before the company collapsed because of negligence.
It's remarkable, isn't it? It really highlights how sometimes those institutional guardrails just fail. They didn't hold the old guard accountable when the warning signs were already flashing.
Okay, so management messed up operationally, financially, and the governance failed. The stock price obviously paid the price. But did it fall too far? Does it look like deep value now quantitatively?
Well, purely by the numbers, it's certainly screen keep now. The collapse pushed the trailing PE ratio down to about 10.5.
Which is well below the classic Graham value threshold of 15 CAS.
And the price-to-book ratio fell to around 1.43.
Also just under the typical 1.5 threshold. Pass again. So statistically, it looks cheap.
It does, but, and this is a big but, cheapness doesn't automatically mean safe or a good investment, especially after a crisis like this. You have to look at the balance sheet health.
Right. Is the foundation solid enough to support a turnaround? How are the safety metrics?
That's where the red flags pop up. The debt-to-equity ratio is high, around 1.21. Ideally, you want that below 0.5.
Okay, fail there. What else?
The current ratio, measuring short-term liquidity, is only about 1.06. You really want to see that above 1.5, preferably 2.
Fail again. Any other concerns?
Yes, the interest coverage. Because of the high debt load, interest expense is now eating up about 20.4% of their operating income.
Ouch. That's above the typical 15% safety limit. So high debt, weak short-term liquidity, and a significant chunk of income going just to pay interest.
Exactly. The balance sheet is definitely stretched. That high debt reduces their flexibility and makes them vulnerable if things get worse or rates go up further. It's the core risk here.
So if the balance sheet is shaky, what's the counter-argument? What's the big positive for the deep valuables?
It comes down to one thing, cash flow.
Yeah.
Despite all the mismanagement, Fiserv is, as sources say, a prodigious cash generation machine.
Okay.
Even neglected, the core business just churns out cash. The trailing 12 months free cash flow margin is still really high, about 21.9%.
22% FCF margin. That is strong.
It's huge.
Yeah.
We're talking about roughly $4.6 billion in free cash flow annually. That's the engine. That cash flows will give them the ability to potentially fund the turnaround themselves, fix the business, and service that big debt load without needing to raise more money at these depressed prices.
Right. That FCF is crucial. And it leads to this really startling valuation point, doesn't it, based on that cash flow?
It does. If you do a very simple discounted cash flow analysis like a perpetuity model, basically asking what's Fiserv worth if its free cash flow never grows again, just stays flat forever.
Okay, a zero growth scenario. What's the value?
The calculation suggests an intrinsic value of about $103.81 per share. Now, apply a hefty 30% margin of safety to that because of all the risks we discussed.
And you get a theoretical buy price of around $72.67.
Right. And where's the stock trading now? Around $64.45.
So it's trading 11% below the price you'd justify if the company literally never grows its cash flow ever again.
Exactly. The market isn't just saying Fiserv is cheap. It's pricing in a permanent structural decline in its future cash generation capabilities. That's an incredibly pessimistic outlook for a business of this scale and historical profitability.
Okay, so that pricing dislocation makes the investment case pretty clear. It's a bet on the turnaround. It's a bet on the new management team.
Absolutely. The cause of the problem, the old guard management, they're gone.
Yeah.
And the new team looks, on paper at least, like an A-team assembled for this exact situation.
Let's talk about them. The new CEO, Mike Lyons.
Comes from PNC Bank. Strong operational background, deep banking experience, perfect for shoring up that core financial solution segment.
And the really interesting hire, maybe, is Divya Suryadevara as co-president.
Oh, absolutely. Her background is fascinating. Former CFO of General Motors, so she knows complex, legacy industrial turnarounds. But then she was also CFO of Stripe, the cutting edge of fintech and payments.
Wow, that's quite a combination, GM and Stripe.
It's an elite blend. She brings expertise in both the legacy challenges and the modern fintech side needed to fix Clover. Seems tailor-made for this dual challenge. Plus, they poached the new CFO, Paul Todd, directly from a major competitor, Global Payments.
Taking talent from the competition, that sends a signal.
Definitely signals they're serious about getting the right expertise and maybe some competitive insights, too.
Oh, okay, so the team seems right. But fixing years of neglect takes time. What's the timeline they've communicated? They're not promising miracles overnight, are they?
No, definitely not. They're being quite careful setting expectations. They've explicitly guided for a margin trough in early next year.
Meaning margins will get worse before they get better.
Exactly. Because they have to spend money now. They're entering a period of peak investments to fix the tech gaps, improve service, hire people. Costs will go up first. Investors need to understand that.
Makes sense. And what about getting Clover, the merchant side, back to strong growth?
They're saying not to expect a significant recovery there until after 2026.
After 2026. So we're looking at potentially 12, 18 months, maybe even longer, of hard work before we see the results in the numbers.
At least, it's a marathon, not a sprint.
Yeah.
They're signaling patience is required.
Now, there's a really interesting side note to this whole story involving a very well-known value investor, Seth Klarman.
Yes, Baupost Group. The sources show he initiated a big position in Fiserv back in the second quarter of 2025.
Q2 2025, so before the collapse.
Way before. He bought in based on that old optimistic guidance. His average price was around $172.41 per share.
Ouch. So he's down, what, over 60% on paper?
Yeah, the timing was, financially speaking, terrible. 5 months too early.
But what does that tell us? Does it just mean even legends get it wrong sometimes?
Well, yes, but I think the more interesting takeaway is why he likely bought it then. The fact that one of the most disciplined, respected, deep value investors on the planet saw compelling value in Fire's underlying franchise at a price almost 3 times higher than today.
Ah, okay. So even though his timing was off because management wasn't truthful, his underlying analysis probably supports the idea that the core business is valuable and durable despite the mismanagement.
Exactly. It adds weight to the current deep value argument. If Klarman saw value way up there, maybe there's even more compelling value down here if the new team can execute the turnaround. #tag outro.
Okay, let's try and wrap this up. As you listen, Fiserv really presents this stark contrast, doesn't it? On one hand, you have the bear case, the heavy debt, the tough competition, the real technological catch-up needed thanks to the old management, all classic signs of a potential value trap.
Definitely. But then you have the bull case, this massive, sticky franchise, especially on the banking side, that just prints free cash flow, a real cash machine. And now it's run by what looks like a top-tier turnaround team. And crucially, the stock is priced as if the company's going to shrink forever.
So if the new team even just stabilizes things and gets back to modest growth, the potential upside could be significant, given that starting valuation. It really all comes down to execution.
At the end of the day, yes, it's a bet on Lyons, Suryadevara, and Todd fixing the mistakes of the past.
So since the new team has thankfully stopped the buybacks for now and is focusing on those peak investments, here's a final thought for you to ponder. Over the next, say, 12 months, what's the most important signal that the turnaround is actually working? Is it seeing that free cash flow number hold up or even grow?
Or is it actually seeing the profit margins contract? Seeing them get worse temporarily, because that would confirm they are making those necessary, painful investments to fix the competitive gaps. Which metric tells the truer story right now?
Interesting question. Something to think about.
Indeed. Well, thanks for joining us for this deep dive into the Fiserv situation.
And remember, everything we discussed is based on public information and is for educational purposes. It's definitely not investment advice. Do your own homework.
And if you do find tracking market sentiment helpful, you can check out that iOS app we mentioned, Buffett Indicator, over on the Apple App Store.
We'll catch you on the next deep dive.
用一記選字，換選字，瓜為多，及欠字。
信息上字，積極前字，一個是寬點，建立及前字。
是欠字，固定狀，盡在字。
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you want to listen our full deep dive about this topic, welcome to join Deep Value Club membership or subscribe us on Apple, Spotify Podcasts channel, Deep Value Investing.
我亦當冇只傳出上至主當理之上啲事噶，是當冇危機突抗起那些，實時關係往往有為，都是很危機框架成出性質，是長期拍攝探視中性質，風機框線向出經濟上的。
是經濟，溫情相似，是經濟從經濟，好當是可控經濟，這件事是事業，經商務利益控制，是上古情。是政府进行的第四章节控管，进行上经济拦截方果。